Good afternoon, Money.net Live. Welcome. We got Tyler Wood from the CMT Association. You are live from the Game Forum Conference in New York City. How are you, Tyler?
I'm doing great, Steven. It's good to see you, Big Meat.
It's opening day in baseball, man. How bad can it be?
The Cardinals are playing, and students from all over the country are here in New York City attending this game forum, which has been an awesome conference already. This morning, Tom Keene kicked everything off, and we're talking a little bit about recession worries. We're talking a little bit about institutional money allocation. And frankly, the markets have been frustratingly stubborn in their constructive and bullish environment. Tomorrow morning, I'll be talking with Jim Bianco and Urian Timmer, global macro strategist of Fidelity, both CMT charter holders. We're running the morning keynote panel discussion. Really looking forward to that and getting their views, not just on markets, rates, the banking crisis, but also on how investors should be thinking about allocations longer term through the rest of this year.
Yeah. And, we've just had some selling here in the markets here a little bit. It seems that the volume is drying up, but just a little bit here. The big word that I've been hearing all over is the big bad R word, recession. Are you hearing the same thing?
Of course, everybody, financial news media is built on doom and gloom. In fact, Tom Keene was teasing several of his panelists for being too optimistic. That doesn't make for good radio or TV. But I think what all of us, right, all the viewers of Money.net Live and members of the CMT Association and investors writ large, what we're trying to do is separate our emotions or our conjecture about where we're headed from the data that's available to us right in front of our faces. And Stephen, I know a lot of folks are trading shorter time frames. They're looking at intraday data. But I want to encourage everybody who's listening to this to every once in a while, take a step back, when in doubt, zoom out. And here we are at the end of the month of March, at the end of the first quarter, at the end of a really difficult 2022. We've been in bear market territory, a lot of frustration for investors. But what I'm seeing on the S&P 500 over here on these far right weekly bars is that we have entered a go trend, and now we have strengthened in terms of that trend configuration, that blend of all the technical indicators in the background. And I know everybody's focused on that y-axis, right? The volatility and price moves. But think about how the healing power of the x-axis is there as well, right? We have been stabilizing, creating higher lows as the market has digested a lot of that bear market action. And what we're seeing from a trend perspective, longer term on this weekly chart, is that there's a lot of constructive evidence under the surface, at least for US equities. And actually, we're seeing some of that globally as well.
Yeah. And what's interesting to me is I had to look it up again. I look it up again, the S&P, surprisingly, I look it up, rose an average of 1% during all recession periods since 1945. It always seems that the markets push up during recessions.
I think the markets love a wall of worry, right? That investor behavior is actually what gives duration to bull markets, because not everybody believes in it right away, right? We're so despondent after the losses during the bear market year. So certainly the banking crisis, collapses in Silicon Valley and Signature Bank and all the others have threatened, I think, a lot of people's belief in the fact that this could be not just a cyclical bull, but actually resumption of the secular bull market. And when the economy is in recession, that doesn't mean that the markets are tanking at the same time. The market is a leading economic indicator, right? Most of the time it is sniffing out 6 and 12 months ahead. And right now it looks like the S&P, the market likes what it's seeing on that front horizon.
It seems to be that it's more wrapped around what the Fed is doing more than anything else right now, the macro side of things, considering we have so many global issues like China and Taiwan and obviously Russia, Ukraine, oil issues right now, oil back to $74 a barrel. I think let's start with the oil first. I think you had an oil chart ready to go. We saw where the Secretary Granholm of Energy was talking about how, we don't have to buy oil all of it right now. We can slow it down a bit. That kind of shocked the markets a little bit. It fell, and now right back up we go, back to $74 a barrel here.
Absolutely. Sorry, this chart is taking its own sweet time to load. But yeah, on a weekly basis, what we've seen in at least US oil, right, is that super sharp run in commodities throughout 2022 has really tapered off, right?
Yep.
We're in a no-go trend. We're seeing that drift lower, but it's not decisively lower, Stephen. We're not seeing the collapse in oil that had preceded. So when we zoom out to that longer term perspective, yes, this is not trending higher, but we haven't seen the massive destruction, right? We broke down out of this sort of sideways channel, and we've quickly recovered back into the channel range, right? That's what you're talking about, that those recent weeks of big gains in the oil markets. I think that the market is designed to frustrate as many people as possible. So all we can do as investors is react responsibly to what information we're presented with. I certainly wouldn't be super long oil on a long-term basis right here, but this isn't the kind of destructive downward sloping chart that we saw in non-profitable tech or the ARK ETFs or SPACs, you name it. That's not the kind of collapse that's happened in oil.
Yeah, one of the things that we also talked about, and I think people keep their eye on, is also the TNX, the 10-year notes here. I'm just had to look at it myself. 3.576. We got down not too long ago to under 3, not too long ago. But TNX here, interesting to me.
I like this quarterly perspective, right? Because the shock that we had, right? This was just mean reversion from 2020 and 2021, right back to that long-term downward sloping trend line that started just about the time I was conceived, I think, if I'm not mistaken. So we broke above the downward sloping trend line. That's a massive trend inflection that global macro experts and big economists have been watching. But what I think is lost on a lot of investors, these are quarterly bars, right? That's 3 months of data at a time. What we can see is that markets move in 3 directions, right? We can be in an uptrend, we can be in a downtrend, or we can be stuck sideways. And the concept that keeps coming from some of the best analysts on the street, including Jim Bianco and Urian Timmer, is that we could remain higher for longer. And I think the Fed has been very clear about their intentions to fight inflation. They're doing that with a liquidity crunch that certainly caused some of the tumult in the banking sector. But what we're seeing here is that we're in a go trend, a weak form go trend on a quarterly basis. We broke above that downward sloping 40-year trend line, but we're not off to the races, right? We're not heading right back to the highs of 1980. What I think we're seeing right now is that consolidation. So if we jump down a couple time frames, let's just look at this on the weekly basis. We're in no-go trends on those shorter times, right? We've fallen out of that strong bullish go trend in terms of yields, and we're in neutral territory. These are what we call go fish bars after Jesse Livermore's famous quote: "There's a time to go long, time to go short, and a time to go fishing." Right. So all of the inputs in the background are at neutral. And then if we dive into the daily, we can see that actually there's been a lot of bond buying, right? Yields move inverse to price. Sovereign bonds, I guess folks are optimistic. And so we're seeing those yields actually in a no-go trend on the daily basis. This is not that rising rate environment that we were seeing in 2022. This is a range-bound, choppy mess on the short-term basis. And I think we could stay here for quite a while.
I think one of the things you just showed quite clearly to me, and I am shocked that I've actually seen this the way you see it now, is the quarterly on this. And I had to look at the numbers, and I just looked at my own numbers here. 2006, I mean, was the last time we were up in these areas on the quarterly chart. And to me, that really solidifies to me that the Fed's making a mistake here by raising rates as fast as they did. I don't think they've ever done it this way, this fast, right?
They have never raised as fast, as much as they have in this hiking cycle. So we're in new territory, right? Famous last words of any economist: "This time is different." But yes, these are new normals, right? And markets are moving faster than they ever have before. So the Fed is very committed to bringing inflation down, and inflation has been very stubborn. The job market is still very tight. CPI and PPI data continue to come in with firm numbers, which supports the idea of a hawkish Fed reining this in. I think what's interesting in the markets is that we have bankruptcies, runs on the bank, right? We have a liquidity crisis. And yet the markets don't seem too disturbed by that. And we're seeing the S&P climb higher in Go trends, despite the fact that there are these banking collapses. So headlines sound super doom and gloom, but we got to react responsibly to the data that's in front of us. And I think from that perspective, we're seeing that this crisis maybe is a little overblown.
Mm-hmm. And speaking of some cool stuff coming up, I believe the CMT Association has a 50th party coming up here, a big conference.
Absolutely, and we are so looking forward to celebrating with the entire community and sharing this with the world. I know Money.net is going to be there. I've had a lot of conversations over the last few weeks with our speakers. Jerry Parker of Chesapeake Capital, famous trend following trader and CTA manager, got started with Richard Dennis in the famous turtle traders experiment 40 years ago. He'll be coming and speaking about new avenues in the CTA space. We'll have the original first president of our organization, Robert J. Farrell, who was the chief market strategist at Merrill Lynch for 50 years. He will be our opening keynote speaker. I just got off the phone this morning with Tom DeMark and Larry Williams, who are closing out our conference on Friday afternoon. Ned Davis, Bob Prechter, John Bollinger, a lot of really impressive money managers and innovators in the field of technical analysis will all be with us. That event is taking place here in New York City, April 26th, 27th, and 28th, actually 2 blocks from where I'm at right now on Madison Avenue. That'll be the location for our conference over those 2 days. But also, Stephen, we're heading down to the floor of the New York Stock Exchange.
I'm excited about that. Good.
We're going to have a great celebration Thursday night with all of these legends of technical analysis, the men and women of Wall Street who actually innovated and created the tools that we all enjoy today. And it's a global cast of characters. Our attendee list is actually at capacity. We're trying to figure out how we can squeeze a few more people in the door and working with our good friends down at the exchange to do that. So it's going to be an incredible conference. We're going to record as much of it as we can, but we're not live streaming any of this. You got to be present to win. If you want more details, you can head over to cmtassociation.org. And this is our 50th anniversary symposium.
I love it. All right, Tyler Wood, CMT Association, GoNoGo charts, Mr. Extraordinary at all the conferences, speaker. I love it. We'll see you right back here next week, man.
Sounds great, Big Beat. You be well. Enjoy those Cardinals.
Go Cardinals. All right, Tyler. See ya.